All right, everybody. It's at noon, and we're going to start promptly here because we have about an equal size crowd online watching this, just to be timely here. So a little housekeeping items, food and drink are in the back. Please grab that if you just came in. Restrooms are over here. And my name is Guy Lehman. I'm an owner and advisor here at Compass Financial. And I want to thank you all for coming. We are a financial planning firm and a registered investment advisor. And most of our practice is in wealth management. And in wealth management, we dive into all these areas: tax planning, retirement planning, investment management and advice, insurance, which we're going to talk about a corner of insurance today, and we get into estate planning and all these other areas. I want to introduce, guys are here, Justin Van Houten in the back, Steve Connard, raise your hand. Thanks, Steve. Caleb Pearson is running the technology today. Michelle Bjorkren, not here right now. Alan Holstein, there you go. And our administrative staff is Joe Aniger. Where's Joe? Thanks, Joe. Julie Greer, Nancy Economist, Cheryl Hurst, and Hannah Mason. So thank you for the Compass crew. Okay, I am going to start talking about insurance as a whole. So insurance actually would come together and pool their resources to help offset that risk, which was a very high risk, ruination if you lost one of your ships. So it started way back then, and it's the same today. Essentially, what we're doing is, what insurance companies are doing is pooling risks or spreading your individual risk among many, many, many different people, all their customers, okay? There's a saying that says the small premiums of the many pay for the large losses of the few. And that is how insurance works generally. Now, I often hear people ask, where does my money go? Well, your money goes three places. It goes, number one, to pay for claims today or this year. Okay, so if you don't have a claim, someone else in that pool has a claim that your money is going to pay for. Number two, it goes towards the administration of collecting premiums, investing money, administering claims, and getting claims paid out. That whole cost is also borne by your premiums. And then number three, at the end of the year, if the company has taken in more than it's paid out, they put a couple cents of every dollar away in a piggy bank for future claims. Okay? And so that's where your money is going every year. When we talk about insurance as an individual client, we always start with the question, can you afford the financial ramifications of any risk? And we all have risk in our lives. It's all over the place. There's fire in our house. There is passing away prematurely while people are depending on our income. There is becoming disabled and being unable to work in the same way that affects our income. There's tornadoes and car accidents and a risk of a stroke to run up a big medical bill, right? These are all risks. And for every piece of insurance, you start with the question, can I afford the financial ramifications of this risk if it happens to me? If the answer is yes, and think about something as simple as a fender bender. If you get in a fender bender and it's going to take $2,000 to replace the bumper of your car, can you afford that risk? Many people, the answer is, yeah, I can. Okay, so you may not need to insure that type of risk. Go to something much bigger. and we're gonna talk about personal lines personal lines insurance today, which is homeowners and auto, and then something we call umbrella. So that's what we're going to be talking about today. And so think about a fire to your house. If it's a bad fire, not and traveled right over to Valley West, and we're talking like racquetball size hail, very damaging. So an insurance company looks at that and says, hey, we got a hailstorm here. It's going to cause $500 million in damages that we're going to be responsible for paying. Can we afford that? The answer is yes, right? They're fine. If the answer is no, the insurance company can go out and get an insurance policy. And that's called reinsurance. Very interesting, isn't it? Not a lot of people know that. Insurance companies have their own insurance. And so what they say is, here's an example. We have a $50 billion insurance company. We got one in town. It's nationwide insurance, $50 billion. That's what they have set aside for claims. So they may say, hey, in any one event, we can afford to pay out $1 billion for any one storm or fire or tornado or catastrophe, right? So, and then we can afford 10 of those every year. So we can only afford a $10 billion year of paying claims out. If it goes over either one of those numbers, so if you have one hailstorm that maybe ends up being $2 billion, what happens is Nationwide would pay out $1 billion from its own reserves, and it would pass along that claim, the rest of that claim, to their reinsurance company, who would be responsible for the rest of it. Okay. So one of the things that's going on in the insurance market, and our guest is going to talk about this a little bit too, is reinsurance premiums are going way up, because what's been happening the last 5 years, specifically down in the Gulf Coast? Bing, bang, boom. Hurricanes, devastating hurricanes, all the way across Florida up into Texas, all sorts of stuff. Tons of costs, tons of claims, very, very expensive. And a lot of times, most normal years, companies don't get into their reinsurance. So reinsurance has been very, very profitable for a long time. Not so the last 5 years. Okay, so premiums have been going up. Go back to that saying, the small premiums of the many pay for the large claims of the few. Well, let me tell you, the large claims of the few have been going up in cost, and the few has turned into a few more. So more claims at higher cost. And what does that mean for us, the many? It means premiums are going up. Okay, so just some very general, big, broad ideas about how insurance works, why it's there, and a little bit about what's going on in the insurance market. I want to introduce Joey Hinke. He is a longtime friend of Compass. Joey owns Vibrant Insurance in Waukee, Iowa. He's an independent insurance agent, which means that they work with many different companies to find the right spot for their clients' specific needs. Little disclosure, Joey is my insurance agent, And I brought my renewal with me, and we are going to be peppering him with questions out of my renewal for a lot of, and we're going to talk about kind of each line of coverage and what it means and how you should be looking at it and what it means for you. So, Joey.
Thank you. I do want to say something. Guy talked about when the insurance business started. An easier way to understand when that was is when Chris McClendon was a teenager. That's when the insurance business all took off. So it was kind of interesting. If you just need a frame of reference, that's really when the whole insurance business took. With Ben Franklin, I believe, was the one that started, right? Yeah. So interesting. But I appreciate you guys giving me some time here today. I'll give you a quick background of me. I started our insurance agency back in 2009, the Monday after the Super Bowl. The reason why I remember that is because not only did my team lose, I also ran out of money that same day. And when I started the business the next day, it was an interesting day for me and my family. But we're out Waukee. All we do is we take care of property and casualty insurance. That's all we do. We don't do any life insurance or employee benefits or anything like that. This is all we focus on on a day-to-day basis. So it's really important for people to understand this, and I appreciate what Guy and Caleb and the crew here at Compass is doing for you guys. So we're going to go through a lot of basic stuff with home and auto insurance today, but we're going to open it up for some questions too, I believe, at some point. So that if you guys have anything that's really chewing on your mind right now, or something that's gone on in your own personal life, we're happy to open it up to have a specific conversation about anything that you all might want to understand just a little bit deeper. And then Guy's going to go through his own insurance renewal that I was told when I walked in here. So I'm going to be put like under a heat lamp here in a little bit, I think. But we'll all go through that. And Guy, do you want me to walk through some of this basic stuff?
A little bit. We're going to stick to a general outline of what's up here, but I want to go through and just talk. When you say property and casualty, I'm going to use different terms. I'm going to use property, yes. Casualty means liability. And do everyone know what the word liability means? It means the bodily injury or property damage you caused to someone else. That's liability in the terms of what we're talking about today.
And think about it also in terms of if you get sued for something, this is the bucket of money that you get to pull money out of to help protect you. And it helps you hire an attorney and helps you pay for damages. Those two things.
All right. Homeowner insurance basics. Homeowner insurance basics, there's several lines of coverage. And this is an outline of what we're going to talk about. We're going to talk about homeowners. We're going to talk about auto. We're going to talk about umbrella. And throughout here, sprinkled, we're going to talk about the importance of adequate coverage and what happens if you don't have quote unquote adequate coverage. And then at the end, we're going to talk about what's going on in the marketplace that I've alluded to a little bit, and end with some Q&A. So here's some understanding insurance coverage in general. Liability coverage. Just like I said, when you cause property damage or bodily injury to someone else. Some examples are if you're in an automobile and you hit another car and that people in that car are injured or go to the hospital. If you're riding a bike, an e-bike, and you hit somebody, which actually happened at my house. And if when you cause property damage or bodily injury, when someone's walking on your sidewalk and it's not scooped properly and they slip and fall and injure themselves, your liability. So liability coverage is one. Property coverage, this is for your stuff. This is for your house. This is for your personal property. This is for your auto. So if you hit somebody, there's two things going on. There's damage to your vehicle, which is covered by the property coverage portion. And then there's damage or bodily injury to someone else, which is covered by the liability portion. Both of these coverages apply in both homeowners and auto. Okay, so you have both of these coverages, liability and property in your homeowners, and liability and property in your auto policy. However, both are also limited by the insurance contract. And I hold this up because this is about 40 pages. And one of my questions is, the first 10 pages are the stuff that has my information on it. The last 30 pages are insurance forms.
Mhm.
Important for me to keep or not?
I think it's wildly important for you to keep, and here's why: nobody does, for one. And because what happens is, but let's go back to the reality of what happens when something bad happens, right? When something bad happens, meaning hail hits the roof of your house, you hit a deer, somebody trips over a hose when you're sprinkling your lawn, at nighttime. What happens is people get scared and nervous, right? And the last thing that people, meaning all of us, are going to worry about is, where the heck is my insurance policy? That's why you have somebody, to help translate that stuff for you. But it's important to have and to understand for a lot of different reasons. Number one, when something happens, it's easy. You want to understand what you're on the hook for. And what are you on the hook for other than paying the premium of your policy? Something called a deductible, right? So like when the hail hits the roof of your house, you want to understand what's your out-of-pocket risk that you have for that. And those things are changing, and we can get into that a little bit later of what the market's doing with deductibles and things of that nature. We can talk about that at a deeper level.
Yeah.
But just to gain an understanding of what that is, because the reason why I mentioned that, understanding what's changing is, there just used to be one number, right? No matter what happened, it'd be $1,000 or $500 if something bad happened, and that's what it is now. Because of what's happening with the weather patterns and things of that nature in the industry abroad, specifically in the state of Iowa, the industry's changing that. And what they're doing is they're saying, hey, here's one deductible for most stuff, and here's a separate deductible if wind or hail falls in Iowa. But let's be honest.
Pause and talk about what a deductible is. A deductible is the money that you're responsible to pay before the insurance policy kicks in.
Mhm.
Okay.
But what's going to happen in the state of Iowa? How often do you hear about a house burning down? Very rare, right? But what you do hear about is greenfield, in the state of Iowa, especially in the last 5 years. It started with that derecho, and I don't know if any of you remember that day specifically, but I was standing out in my office. We have a patio on the second level of our patio, and I didn't think it was that bad until I saw it was garbage day in Waukee. I saw an army of garbage cans just rolling down the street, and then a trampoline flew by my face on the second level of that building. And then that's when I knew that we needed to do something here and get it in the basement. But really, that was the day that it all started in Iowa, because Iowa is one of those places, generally speaking here, where it's not just a good place to raise a family and a great place to buy and build a house and to be here, but from an insurance standpoint, if you're just talking about my nerd world that I live in, it was also a very safe place to live from an insurance standpoint, really insulated from catastrophic things like hurricane, or who had ever heard of a derecho before, 5 years ago, right? I didn't even know what it was. I thought Ed Wilson made up the term, when I heard it on TV. But, at the end of the day, a lot of things, since that was a big trigger point in Iowa where things started to happen and things started to change here in the state of Iowa. That's what Guy was talking about. Like, when things start to change, then things need to change as an industry. And we can get into that a little bit. But for the most part, he laid out a good, outline in terms of what you're responsible for, and to understand that, I think, is a big deal, especially now.
So let's talk a little bit about homeowners insurance. And again, there's two aspects to homeowners insurance. There's the property coverage, which covers your property. And then there's liability coverage, because things happen. Mm-hmm. And this liability coverage doesn't just cover things that happen on your property. They can cover things that happen when you're out and about. So let's first talk about the property side, and I'm going to flip to my declarations page, and this is the page in your renewal that has all your information on it. And I look at my dwelling, and I have a limit on that dwelling. So my dwelling is my house, and how is that limit determined?
The limit's determined in a lot of different ways. All insurance carriers out there subscribe to a software, which is it's by Marshall Swift Beck, is the most easily relied upon software system to determine replacement values that goes onto the dwelling value of that home. What do? They take on the square footage of your house. What's your house made of? Is it brick? Is it wood frame? Is it 1-story, 2-story? Does it have a basement or not? And it takes into consideration the type of roof that you have. Is it an asphalt shingle roof, wood shake? Is it a metal roof? Things of that nature. And they jumble this all into a big blender, right? And they turn on the blender and it mixes it all up. And then based on all of those details about your specific house, it renders out a value for what the replacement value. And this is one of the, like a hot button in our industry, because there's a difference between when you put your house up for sale, you know, there's a value that a realtor will determine, right? And then there's the value that people see on the tax assessor's page, like people have access to that public information. Then you have the dwelling limit that's on your insurance policy. They're all different. And it just makes people's hair hurt when they see that, right? Me included. And there's a reason why they're different. And the one is the market value of your house is just what somebody's willing to pay for it, right? But the replacement value of your house is what would it cost today to replace the whole darn thing with today's materials, today's hourly wage up for a contractor, et cetera. And that's what when I talk about that blender, that's what that software kicks out. And historically, it was really easy in the state of Iowa to come up with that number, because inflation, you know, that's a bad word. I shouldn't even say that right now, but like inflation was like really steady in Iowa. Home prices were really steady. Wages were really steady in the state of Iowa. But what happened was when all these things started to happen, catastrophic claims that started to hit in the state of Iowa, the insurance community started to determine that we're undervalued on a lot of these values with homes, cars. I mean, think about your car, like an old fender bender, like in the car I gave my daughter. I'm sorry, I'm a cheapie, but that doesn't have any sensors in it. You know, it doesn't have anything fancy in it. It's just a standard car that you'd see from 10 years ago. But now if you buy a car that's 5 years or newer, or maybe even 10 years or newer, there's a whole bunch of stuff inside of that bumper where it used to cost $1,000 to fix, now might be 10 grand to fix. The insurance business in Iowa never really caught up to that in terms of those inflationary numbers, especially with homes. You know what I mean? Where like a stack of 2x4s used to cost one amount, and now it's a bigger dollar value. And so that's what they're really talking about and trying to determine with that replacement value. And when you talk about that though, with your house, in Guy's policy, and I would say 99.9, you'd probably agree with me, the policies out there are replacement cost policies. And what that means is when you hear the word replacement cost is like, kind, and quality. So if your brick house gets hit, if a claim comes in, they're gonna go out and get bids for another brick to replace it, right? At today's replacement cost, they don't depreciate it in any way. So when a claim happens, they just look at it, they take your bid, take your deductible, and then whatever's left over after your deductible is what the settlement of a claim would be. That's really how it is right now.
Yeah, good. So the key point there is your cost to replace your house is often quite different than the market value of your house, and probably significantly more. Okay, so that's my dwelling coverage. There's other structures coverage. And I believe that means if you have a shed, or what does that mean?
It could mean a lot of things. It could mean anything that's detached from your main dwelling of your home. And depending on the carrier, this can be a very broad definition. I always talk about definitions in terms of the promise that the carrier is making you, right? So most of the time it's like, think about your garden shed in the backyard, or maybe it could be a greenhouse where you grow your tomatoes or your plants and stuff like that in the backyard. Sometimes it could mean a patio, you know, sometimes it could mean a boat dock. It can mean a lot of different things. And depending on your carrier, that's why when Guy mentioned earlier, should I hang on to this piece of paper? Yes. Because when carriers out there, there's a bunch of different carriers that do a really, really good job at writing insurance in the state of Iowa. All of them are great for the most part, but each one of them has a different kind of product that they're going to sell you that has a little different bells and whistles to make themselves different, you know, against their competitors. And this is one of those areas they're subtle, but they can be different.
So the lesson there is check on it with your insurance agent.
Yep.
Another property is personal property.
Mm-hmm.
And a lot of people are like, what's the difference? What is personal property? Mm-hmm. And the way I've heard it said is if you took your house and you shook it, everything that comes out is personal property.
Yep. Yeah, I would say the same thing. If God gave you superhuman strength that allowed you to pick up your house, tear the roof off, and tip it upside down, whatever hits the floor, that's personal property. All your stuff, right? That's what it is. But I would qualify that all your stuff except your boats and cars. You know what I mean?
Yep.
So because they all have anything that you could have a different policy for, that's really what we're insuring there. So all of your knickknacks, beds, desks, everything.
And so how do they come up with that value?
So again, this is one of those things where every carrier is a little bit different, but it's all based on the dwelling value of the house that's listed on the product. So the carrier's trying to solve for that dwelling value first. And then each carrier then will say X percentage of that dwelling value we'll just add as personal property. Some are 80%, some are 90%, some are half. some are 75%. And because you might look at your insurance policy and say, I don't have $400,000 worth of stuff in my house. That's just what the carrier does for you.
Right.
You can adjust that number sometimes up or down, most of the time only up, but you're not being charged anymore per se. It's really based, the charge that you're being, the premium that you're being charged is really based on that dwelling more than anything.
Personal property, another important thing is when you look at your stuff, you know it's not worth much right now, but go try to replace every single thing in your house. I bet it would add up very quickly. And replacement cost is important in this coverage too.
Mm-hmm. Very, because there's some policies that, and this is where we could get into the weeds here, but at a high level, is there certain policies will write your home, will design the policy for your home to be on a replacement cost basis, but your stuff, they'll depreciate. And they will, and some policies will say, you know, you're only going to be covered for a name, things that are named like fire, wind, hail, smoke, vandalism, things of that nature. For the most part now, most products say it's all one thing.
It's all covered.
Like, it's all covered the same way. So if something horrible happens, try to remember how much stuff you had, and then to determine what the loss is.
Well, that brings up a good point. One thing that you can do that in the event that you have a major loss would really be helpful is a video or pictures of the inside of your house. Like just go in every room and take a little panoramic or take a picture and put that in the cloud or in an email somewhere to yourself. So if you ever have a fire in your kitchen and it damages, you know, really burns something up, you can go and say, here, you can show the insurance company, here's what it looked like before, and here's what we need to return it to. One more under the property section is loss of use. Mm-hmm. What is loss of use for property?
When you think about that, we go back to something bad happened, right? So this coverage is always triggered when something bad happened already. So think of that fire event that might happen in your kitchen that causes you to go out and temporarily go to a hotel room, or you have ongoing expenses at your house that continue to, you get bills for on and on and on, even though you're not living there. This bucket of money for loss of use, that's what that's for. Think about to rent a new place or to keep the ongoing expenses of your home paid for. That's what it's for. And a lot of carriers do this on an unlimited basis now. Some carriers will put like a giant limit out there and you'd think, good Lord, how would we ever get to that amount of money? And then other carriers, because it's very rarely used, just say, hey, we don't care what the amount of money is and the limit is time. So they'll say you have a whole year worth of time, and as long as you're back in your house within a year, we'll give you whatever that cost is for that time that you're away from your home.
Okay, very, very helpful in certain situations.
The big time. I mean, because especially now, if you think about, has anybody tried to build a deck or tried to build a shed in their backyard recently to get a contractor to come to your house? Because everybody's really stinking busy right now, right? And so to get somebody to come to your home with urgency right now is really, really difficult. Even though something bad may have happened, they're going to try their best to get there. But that's why they put a big limit out there, because they know that it could take a long time. And then the timing on construction, sometimes with material, waiting for other subcontractors to get out there, it can take more time than you'd think.
There's a couple little additional property coverages here that I have. Backup of sewer and drain. Tell us about that.
It's exactly what it sounds like, to be honest with you. Think about your sump pump in your house, or think about your sewer drains in your home. When we have a big event that's happening out here, it could be related to a storm, it could be not related to a storm. Anything that leaves the sewer or your sump and floods your basement, this is the type of coverage that you need. Now, one thing, carriers limit this to a small amount, right? So you're never going to get $1 million worth of coverage.
Hold on, they limit it to a small amount. Why?
Because in your mind, there's a couple different reasons, in my opinion. Is one, everybody thinks when your basement floods, it fills up like a soup bowl all the way to the ceiling. Never happens. The worst that I've ever seen, really, a basement will fill up about that big. You know what I mean? And then so when contractors come in, you get made whole, meaning the damage that's caused is what gets replaced. So you don't really have to replace the ceiling lights if the only thing that's damaged is your carpet and the lower 2 feet of your drywall. And so that's one of the reasons why they limit that amount of money down, because they know that over time, really smart dudes that are sitting in an office in those big buildings, the actuaries have determined that here's the limits, and they give you the power of choice as the customer as well. Like some policies will automatically include a certain low value dollar amount. What I mean by low value, think $1,000 or $5,000 that they would throw in there. Then they give you the choice that you can buy 10, 20, 25, 50, $100,000 or more of that specific coverage. And then you get a choice to do it. And it's very inexpensive.
It's one of the most common claims too,
It's
isn't
one
it?
of the most common things that you'll see, to be honest with you, especially related to your house, because everybody
Yep.
tries to insure against the big event, but
Yep.
it's the small events that really happen. you know,
So,
most
so
of the
I
time.
would say backup of sewer and drain ought to be on your homeowner's
Mhm.
policy.
Mhm.
So check that out. There's others. There's a cyber protection plus a service line coverage, which covers the
Can we talk about this?
Yes.
Because this one's really important.
service line coverage. Does it cover sewage going out or
Well,
water
think
coming
about it.
in?
Think about it like this: if a utility line that comes to your house from the public utility in the street all the way to the foundation of your home, has anybody ever had a neighbor or it happened to you where that line collapses, or a tree root grows through it, and the next thing you know, like you have your yard's torn up and you have all these expenses associated with it? You can now buy insurance for that. Okay, and it's very, very inexpensive coverage. And what it does is it just pays for, and again, very in a similar fashion to sewer and water backup, you buy a specific limit and then it pays for the replacement of that. The one limitation of that coverage is this: if the pipe that broke is under the foundation of your home, it's not covered. So it's meant to cover from the foundation to the public utility, which is where 99% of the claims happen. It's very rare that something would happen under your home, but when that does, that's one limitation of it. But this is something that for dozens of dollars a year, not hundreds of dollars a year, you can get that covered.
Yep.
And we see those claims happening more and more frequently as homes age and neighborhood trees get bigger, and as roads start to get fixed and stuff like that in neighborhoods where large vehicles are driving over top of things.
Good.
Yeah.
Okay, so that kind of concludes the property part of homeowners insurance. Let's talk about the liability
Mhm.
part of homeowners insurance. There is a personal liability limit
Mhm.
and a medical pay limit.
Yep.
So talk about both of those. What's personal liability?
The biggest difference between these two things has to do with one word, and it's negligence. Okay? Liability, that gets triggered when you are determined to be negligent. Okay, what's negligence then? You have a duty owed to do something. You breached the duty
To be reasonable.
to be reasonable.
Yep.
And so, and I'll run through an example of what I mean by this. Then something happened that caused damage, right? So what could that be? Let's go back to the sprinkling your lawn, right? I have my son, he runs sprinklers out to that small patch of grass between my garage and on the other side of our sidewalk, right? Every stinking night I say, put the sprinkler back in the garage, and he leaves that dang hose go across the sidewalk, right? So we have a lot of walkers in our neighborhood, right? Some with baby strollers and some just that are out walking to get exercise, right? And so if somebody trips over that, even though that we knew that we should remove that because there's an inherent danger, I'm negligent if somebody trips over that and I didn't do it and I knew I should have done it. And if they break their arm, they break their leg, and then they sue us, that bucket of money in the liability portion is going to pay for my attorney and pay for that broken arm, right? Flip side of that, and this is a real life example. We were that neighborhood, we had the swing set in our backyard. It's like having the trampoline. Best, worst idea of all time, right? So we had the swing set in our backyard, and our kids constantly had the neighborhood kids over at our house. Everybody's chasing each other across the jungle gym, things of that nature. Kid gets on the jungle gym, falls off, breaks his arm. We're not negligent. It just was an accident, right? So what the medical payments provision is, it's a smaller limit, usually $1,000, $5,000, or $10,000. What it is this is that bucket of money that says, hey, you had to go to the ER, you needed an ambulance ride, you needed to get stitches. This is that bucket of money that you don't have to be negligent. It just pays out. And then after it pays out, this is where when attorneys get involved, it always makes me a little queasy. But after you accept the money, the person that takes the money has to sign off and say, I promise not to sue you. So that's the one thing. And to be honest with you, that small little bucket of money on these insurance policies prevent a lot of, more large calamitous claims that might otherwise come in from a liability standpoint.
So question for you. This happened at my house. I had a daughter run out to the sidewalk. There was a blind corner on our property due to hedges, a bush, and she was hit by an e-bike.
Mm-hmm.
How, with the prevalence of e-bikes,
Mm-hmm.
there's a trip to an emergency room, everything worked out fine. However, should that have not worked out fine, is your homeowners covering your e-biking around town?
I can only answer this with an opinion right now.
Okay,
My
not a legal opinion.
Yeah,
We're not attorneys.
No, my opinion of this is, as I would go back by, I would like anything, let's start at the end and work backwards,
Okay.
right? So is the e-bike required to be insured by the state of Iowa on its own, like a car? Like you have a financial responsibility law in Iowa that states that if you own a car, you have to put at least liability insurance on it, right? Is that required in the state of Iowa? I believe the answer is no right now.
For most e-bikes, there's a class
Right.
of e-bikes that can go
Based on
40
the,
miles an hour.
the
right?
horsepower and stuff
Yep.
like that, right? Where if it's not a license, required to be licensed for one and required by the Iowa Financial Responsibility Law, in my opinion, the homeowner's liability would follow that.
Well, it's just like riding a regular bike.
Yep,
If you're out riding a regular bike and you're negligent or you hit somebody and it's an accident,
exactly.
the homeowner's coverage gives the homeowner's liability gives some coverage there.
Yep,
right?
it provides it. Your homeowner's liability is going to follow you really wherever you go. So like me being here, if Guy and I get into an argument here because we have a difference of opinion on liability rules and he punches me in the nose, his liability from his home is going to cover him here for that personal injury that he causes me. So that's one of those situations that would be, but one of the things about insurance is this though too, is rules in insurance and insurance coverage follows stuff like this. Bad things happen that are vague and weird, and then we don't really know where it lands. That's what causes language in insurance
it
policies
goes
to be
through the
written.
court system as a lawsuit.
And it creates different things,
Yes.
right? It creates a product, if you will, saying, oh God, we never addressed e-bikes. Who the heck would have known, right? It's but like similar back when cell phones were a new thing, right? Nobody knew, did cell phones cause cancer? Did cell phones cause hearing issues? Things of that nature. It's the same thing.
Okay, we are going to skip the auto basics now. Keep it moving here. Same thing. In your auto insurance, you have both a property section, which covers your property, and a liability section. And we're going to go through the property section quick. Right here, property section first is damage to your auto. There's collision and other than collision, often known as comprehensive. So comprehensive, and collision. Can you explain what the difference
I'll try
is?
to. So collision, you run into something. You hit a tree, you hit a bridge, you hit another car. That's collision. Comprehensive is something hits you, like a baseball, or something like that.
Hail.
Something like that.
Hail,
Hail,
theft,
theft,
Okay.
vandalism, an ink pen in your pocket that goes all over your car seats.
Okay.
Anything that isn't deemed to be collision is going to be comprehensive.
flood.
Maybe.
Okay.
Flood's an
And
animal.
so there are deductibles, of course, on each of these, comprehensive and collision. And you can choose sometimes not to insure a vehicle with that physical damage. And goes back to the question, if you can afford, if you have a cheap car and you don't want to afford, you don't want to pay comp and collision, you don't have to. Is that correct?
Correct.
Okay. So that's the property side. Now, also, there's some property within your personal property in the car. There's usually some coverage there.
Yep. So if you have your laptop in your back seat or your purse when you're going to Walmart or something like that, and you get out of the car and it gets stolen or it gets damaged in an accident, there's going to be certain little buckets of money inside of each auto policy that provides some coverage for that as well.
Here's another thing that I really like, because I've used this a couple times, is roadside assistance. This is, I get stranded on the side of a road and there's a number to call and someone sends me a tow truck. So that's very important, little tiny coverage to have, especially if you have young drivers that you're concerned with. Okay, so we have handled, did I touch something here, Caleb? Sorry. I know, I've been making them nervous. Let's get to the liability part of auto coverage. There's a number of different ways it can be expressed. And you see up there, liability, how much. CSL stands for combined single limit, or you can have multiple limits. And those limits are like 100, 300, 100. If you have that on your policy, it would be $100,000 liability limit per person, a $300,000, what they call an aggregate limit for any one accident, and then a $100,000 limit for any property damage you did. So the first two are for bodily injury. The third one's for property.
And does that
damage.
confuse anybody? Or you got to put yourself in a situation where you have a claim. And doesn't that seem like the kind of a pain in the neck, right? And the interesting thing is too, is like going backwards, is the state of Iowa requires certain limits, but they're really, really low. Like
how low are they?
20, 40, and 15.
Okay,
in those
so
same
my
numbers.
question: you get in a car accident and you injure somebody else. How far is $20,000 going to take you?
It's not a broken. It won't cover a broken hip.
It won't.
Yeah.
It won't hardly cover a broken arm, I would expect.
No. And the biggest thing though is this last number right there, the cost to replace a vehicle, right? Right now, can you buy a vehicle right now for $15,000, even a used one? Like you can't go to Tom's Auto and get a $15,000 vehicle. I tried, like it doesn't exist. I would have found it, I promise. Like, but this is what's interesting. And I always, when I counsel people on these coverages, I default, I am not the smartest man in this room, and I never will be. But I think that having one combined single limit's easier.
So by combined single limit, they say instead of that 100, 300, 100, we're going to give you 500,000.
One bucket of money
to cover whatever happens, property damage, bodily injury, all that stuff.
Right. It just then it takes the confusion out of it, especially when it comes to trying to divvy things up at the end of a claim. Because again, we go back to when something bad happens and you get into an accident. Let's say you go through a stoplight, you rear end somebody, it's your fault, right? The last thing that you're going to want to worry about is do I have enough, right? Because it's going to be confusing. Well, you know, this much, the whole claim, when you get sued, they don't delineate what you got sued for in little buckets. They just say, here's the damage, right? And so it's important, I think, to understand this piece a little bit better and to educate. And I'll also say this, I'm jumping around a little bit. The difference in premium from the state minimum limits to a $500,000 combined single limit is dozens of dollars. Everybody's a little different because everybody has different experience. Some people might have a DUI, 5 teenagers, and a bunch of speeding tickets. Some people may have never had an accident and had the most perfect driving, most pristine driving record ever. That's really what's going to be more determinant of your premium than this.
I'll tell you also, I have a lot of friends in the insurance industry on the company side, and they say they are seeing more and more million or $2+ million claims than ever before. Think about the cost of a helicopter flight downtown. Think about the cost of intensive care. So these claim numbers can pile up really quick.
Right. And the insurance business is all about the boogeyman, right? There's always a boogeyman somewhere in the insurance business. Before COVID, it was auto insurance. That's all anybody could talk about was the jury box being filled with, and I think this is a safe room, but like with millennial like jurors, right? That are giving catastrophic awards to people that may or may not deserve it based on claims that might be a simple fender bender, right? That's driven up a lot of the inflationary stuff that we see in liability. But what happened during COVID? Nobody drove, but insurance carriers kept collecting money but nobody drove. So the claims just shot through the basement, right? And so the carriers became more and more profitable. They were able to fund themselves better. Then what happened after COVID? The boogeyman hit with hail, and the boogeyman hit with tornadoes, and the boogeyman hit with derechos, right? So that all shifted to somewhere different. So that's why when I counsel people on auto liability specifically, it's very, very inexpensive to buy a whole bunch of coverage right now. And that's where when we talk about things like, you know, especially in this with this audience is like, you know, we're talking about saving or protecting the assets that you're taking a lifetime to accumulate, right? And this is the best protection you'll ever buy is liability. Yeah, we can shift deductibles and buy different deductibles on the physical damage of your car, but your car's never going to sue you. You know, your car is never going to come after an accident, come after your nest egg, right? So when I look at this stuff, I think this is the best money that you could spend.
We're going to talk more about that. Let's talk about UM/UIM. And what that stands for is uninsured motorist and underinsured motorist. Okay, so Joey talked about what the state required limits are if you have an automobile, $20,000, $40,000 in an accident. There's a lot of people driving around with that. If you get hit by one of those people, this coverage, it's actually a liability coverage, but it ends up being money for you.
Exactly. These are the biggest claims that I've ever seen. The uninsured and underinsured motorist coverages. Every single year, the biggest claims that we have inside of our agency come in this bucket right here. And what happens? is you're going through a green light and somebody comes off the interstate. It seems to always happen at that 8th Street exit, you know what I mean? Coming off the interstate there, where somebody comes at a high rate of speed down there and smacks somebody. And you got to think, if you get broadsided, you got shoulder, hip, knee, ankle, head injuries, things of that nature. What happens is in these claims, that car who was at fault, their coverage responds, right? But once that number over here expires, once it's gone, it's on you. And then what happens in the reality of it is then you have to pay a deductible, you know. After that, all of your bodily injury and the cost to replace and repair your car, it comes out of that bucket of money. And when we see those, these are hundreds of thousands of dollars, if not bigger, on an annualized basis. And these are just catastrophic claims that come in.
So in essence, you are paying a little bit to make sure anybody that hits you is adequately insured.
Mm-hmm.
That's in essence what it means. They may not be adequately insured, but you can make them adequately insured with your own uninsured motorist or underinsured motorist coverage. Okay.
And not to confuse, and this is easy to put together. So most of the time when you're buying auto insurance, this is going to be offered to you in a similar way that those liability limits are offered to you. So if you're getting this put together, you're going to have a limit of liability up here, and then down on the uninsured motorist and underinsured motorist, it'll be similar, if not the same. But it'll be two separate limits.
Yeah. Completely. So I am paying $190 across 3 autos for $500,000 per person for both of those coverages combined.
It's about $34.
Yep.
Mm-hmm.
So not a lot. Okay. I think that touches on what we want to talk about with, let's talk about umbrella insurance.
Mm-hmm.
Okay, umbrella insurance. And I brought this whiteboard out here to draw something on it for you. So you remember when we talked about your homeowners and your auto policy has 2 parts to it, right? The property and the liability. So down here we have auto, and let's say that has $500,000 of liability coverage in a combined single limit. And your property insurance over here, let's say that has $1 million of liability coverage. What an umbrella does is it sits over both of the liability portions of each your auto and your homeowners, and it stacks on top of your underlying liability limits. So if you have a $2 million umbrella, that means $2 million sits right on top of your auto liability limit, and $2 million sits right on top of your property. So in essence, I would have $2.5 million of auto liability coverage, $3 million of property liability and coverage. Okay, that's what an umbrella is it goes over both of those policies, stacks on top of both of those liability limits. And here's why I think that's so important. Number one, and by the way, interesting little note, remember that auto liability, UIM, where I'm buying insurance for whoever else is going to hit me? On certain umbrella policies, that $2 million can stack on top of the 100,000 that I have. So now I have that UIM way up there. Okay, so I have a lot of liability there too, because there's 6 people in my family. If we get T-boned in a really bad accident, guess what? Man, I got way more than $100,000 of problems, don't I? Way more. So that for me is particularly important. But when I think about this, the biggest reasons I like to have a big umbrella policy is because I want my insurance company deeply interested in defending me should I have a lawsuit against me, right? I want them on the hook for a lot of money and really interested in them defending me. And I also want a lot of money if I get hit by somebody that doesn't have insurance. And not only if someone's defending me, but what if I hit somebody and cause a lot of damage, a lot of bodily injury? Part of it in here is like, ooh, part of my responsibility is to have a big limit in case I T-bone someone else. I don't want them shortchanged. I don't want, so there's a lot of things and reasons why I think umbrellas are particularly important. By the way, Joey told me a long time ago, as soon as you have driving kids, he's like, take your umbrella up to X amount. And interestingly enough, we've added a 16-year-old driver, and right now the marketplace won't give me the higher limit because things are getting kind of tight right now. So I'm kind of stuck where I'm at right now. But when the time comes and I can get approved for that, I'll be adding it if the company will accept me. What else to say about an umbrella?
This is very, very inexpensive to buy. If you're budgeting for something like this, and again, everybody's risk profile is a little bit different. McClendon's got his helicopter, private jet, and everything that he does, like that highfalutin lifestyle that he lives. But for the most part, if you're going to try to budget for this, about $200 or less per $1 million of coverage. That's about what it's going to be. Now, will it be more if you have a lake house, a house in Colorado, 5 teenage drivers, and things of that nature? Of course, it's going to be a little bit more than that. But for the most part, if we're like a standard vanilla, house, 2 cars, and a golden retriever, that's about what you could budget for it, and what it might cost you annually. So it's very, very inexpensive for that type of insurance. And it's one of those things too, like you laid it out well. What does it do? It's extra liability over your auto, the uninsured motorist, and your personal liability. So,
okay, we're getting close here. I want to go back through and talk a little bit more about some of the most common types of claims. Mm-hmm. And from what I hear, it's of course auto liability. You have a fender bender and your own personal. But what about homeowners? For instance, your roof. Mm-hmm. There's a lot of angst in the insurance market right now about roofs and cost of roofs. Explain the difference between replacement cost coverage and actual cash value coverage.
Mm-hmm. So replacement cost, we talked about a little bit earlier, is going to be whatever it costs to replace that exact thing, like, kind, and quality, at today's cost, period. So you have a roof that goes bad, or a roof gets damaged by hail, let's say. You're going to go out and get a bid for it. Whatever that costs to replace that is what you're going to get, right? Period, minus your deductible. So actual cash value is a different way that some carriers will address this, and that's the same thing, except they depreciate it. They take it. So if you have a 20-year-old roof, they're going to depreciate it by that small percentage.
So it's not so small.
It's not so small.
I have a schedule right here.
Yeah.
And they sent me a schedule for roof depreciation. If you have an asphalt roof, which most people do, and it is 15 years old, and your roof, they will pay out 55% of the cost of replacement for your roof.
But what's interesting, what Guy's talking about too, is they publish this in your policy, this loss settlement clause for roofs, right? This is new since Armageddon started happening in Iowa 5 years ago. Yeah. It used to be you just had to guess at or about what you think your roof is worth. Well, let's go back 10 years. Like on the standard, 2-story home in West Des Moines, might cost about $9 or $10,000 to replace your roof. If you had to tear it all off, replace some of the sheeting, new gutters, downspouts, stuff like that, about $9,500. The average roof replacement right now for that same house is about $30,000. And so, but nobody knew that, right? Because I didn't know that until I needed to replace a roof, right? But at the end of the day, so what happens is now with all this stuff that's happening, carriers are trying to figure things out, right, along the way with how to do this in a more meaningful and pragmatic way so that people can understand things better. So what they're doing, they're putting it right into the bones of your policy so that there's no guesswork. But what it does is scares the heck out of people when you say 55% is all I'm going to get for this roof, right? But at least you have the understanding of how to plan and things of that nature.
A 25-year-old roof, they will pay 25% of replacement cost. Okay, so that's something to keep in mind. The other thing is deductibles and what's going on in that space.
Mhm.
You talked about a little bit,
Yep.
but sometimes they're coming and saying, "Hey, on your house, we're gonna force upon you a $5,000 wind or hail deductible on your damage." So if you have wind or hail that damages your siding, your windows, your gutters, or your roof, you're responsible for the first X amount. Okay.
And what we're seeing there though is $5,000 is fine because it's a finite number, right? And you can understand, I can understand $5,000. I'm not a bright man, but I have a calculator, right? What we're seeing is carriers are putting up percentage deductibles for wind and hail. And what that is to be very, very clear what that means. That's a percentage of the value of your home that's determined by the insurance carrier. We talked about that earlier, how they get to that dwelling cost on your replacement or on your policy. So if a wind and hail event comes now, I just implore you to be acutely aware of what that deductible is for wind and hail. So you have a $500,000 house and a 2% wind and hail deductible. It's 2% of that $500,000 that's on your policy that you're on the hook for your roof.
10 grand.
So it goes back to that. So if you have a $20,000 roof, regardless of what that loss settlement states, you're only you're insuring half the roof, right? So, but what that's trying to combat is a lot of people, the way that policies were written historically created a lot of fraud in the system. Meaning, I'm sure that this probably happened. If you could draw a line, half of people in this room probably had somebody knock on their door at least one time saying, "Hey, we fixed your neighbor's roof." Everybody has hail damage when the door knocker comes, right? And so a lot of that created a lot of fraud and abuse in the system. And this is a way that they combat that. And anything in the insurance business is like this. The pendulum swings right and left, right? Like the good times and bad times, right? Right now, it's so far over to the right, meaning the carriers are trying to combat the bad times. But what we're seeing is that in my world, when I want to get out the crystal ball and try to understand what's happening, I listen to two insurance carriers, Travelers Insurance Company and Progressive. It's like they have a crystal ball and they see stuff before everybody else. Most carriers follow them. You know, they tend to move first, right? They have all the data and all the information. Those are the carriers right now that are saying, "Hey, there's a very dim light at the end of a very long tunnel, but at least we're seeing that there's light at the end of the tunnel in terms of breakage and stuff like that with inflation in our world."
So some general advice: review your policy annually or whenever changes are happening in your house. Have a professional agency to work with. And by professional, I mean this is all they do. And keep up with the times, because we can get dead set in thinking 5 years ago, but a lot can change. You've been talking a little bit about what's going on in the insurance marketplace. I talked a little bit about the reinsurance, which is, of course, insurance policies for insurance companies. Any additional thoughts there?
I just think that, the insurance catch up with the world, right? We're one of the most antiquated systems in the entire world in terms of business, right? I mean, anything that we're still tight rolling our jeans and wearing spiked hair. We're like back in the 80s, right?
You're still mailing out 40-page.
We're still mailing out paper to people, right? And so the insurance business is trying to catch up with with everything that has to do with auto values, the value of your home, how to settle a claim, how to, we're just starting meaning insurance adjusters and underwriting. What we're finding out is during the underwriting process, when we go out and we take guys whole family out to market and we want to see if he has the best deal, underwriters are starting to use drone technology and Google Earth to look at the roof now and pre-inspect the roof without leaving their desk. That's finally starting to happen now, right? Where, I mean, there's data out there and there's information out there that hasn't been used historically that's going to help you. Because what will happen is over time, and I'm going to talk about business insurance for real quick, just as an analogy, right? Like, I don't know if anybody here owns a business, but 10 years ago, workers' compensation was broken, like completely broken. And so what had to happen is they had to recalculate how they did some stuff with workers' compensation, which hurt for the first 2 years. But then historically, over the last 8 years, workers' compensation premiums have gone down every single year in the state of Iowa. Same thing is happening with property insurance and auto liability and auto insurance right now. Like, and we're still kind of insulated. We had this conversation right before this started about Iowa's always been very insulated, with a lot of things with weather and with just different inflationary stuff, right? So from an insurance standpoint, we haven't seen some of the fluctuations that have happened. Like if you look at Florida, California, Oklahoma, there's very few insurance carriers left in those states that are willing to even write insurance because of what's going on out there. And so here we still have a market. We still have competition here and that's always helpful. Anytime that you can leverage the market, you put yourself in a good position of strength, as it relates to your expenses out of pocket and things like that. There's going to be some things that continue to change in our business. They're going to, a lot of carriers are going to move to like a published loss settlement on your roof. And in long term, I feel like that's good, right? And you're going to see a little bit of change in your deductibles for your property, right? As long as they're there, you can properly fund for them in the future. What that all will do, where you'll see a little bit of pain right now on that, and in my opinion, again, a poor man's opinion, I think most of the pain in Iowa was washed out. I don't think it's going to get a lot worse than what it is right now. You could actually probably see in the next 18 to 24 months significant improvement in what's happening in the market in general. But for right now, this is about as painful as it's going to get here. And you'll likely see product changes for the better soon.
Okay, so here we are. We've been in an hour. I want to be respectful of people's time, but we're going to keep going because we got a few more things to touch on. So if you're up against the clock, feel free to leave. It won't hurt our feelings at all, but thank you for coming. I want to hear the top things that you consistently see as coverage gaps in personal lines insurance.
Mm-hmm. One of the biggest things you touched on earlier is if it has to do with little things, to be honest with you. It's never the big things that I see that are the big gaps, but what I see are the small things, like you get that rock chip on your windshield, right? Or you get that your windshield shatters. Is that covered or is it not covered? That depends. You know what I mean? Where it has to do with uninsured motorist coverage. Is that covered or is it not? It has to do with two things that we touched on earlier. It has to do with sewer water backup. It has to do with the service line coverage, equipment breakdown in your home. And what I mean by that is think of like a power surge, squirrel walking on a power line. Power surge comes into your house, all your appliances go down. Covered or not? Those types of things. And those are all things that you can add on, but and I always hesitate because it sounds like, wait, there's more, you can buy more, but unfortunately that's how the insurance products are built, right? And it's just about understanding that and having that conversation to see that bigger, but at the end of the day, those little things are the ones that really matter. But what the other things that happen is life, like in insurance business, you buy your daughter a car and you forget to call your insurance agent. Each carrier treats that a little bit different in terms of the time lag that you have in terms of reporting that to your insurance carrier.
Or you buy a car, you change a car,
mm-hmm.
You trade one in and you
Swap
buy a new one.
Yep. Because the auto dealerships make it really easy. If you have your proof of insurance in the glove box, you just put it in the new one, and then they send the documentation. You feel like you're all set, but you have to take that next step and to make that call or communicate.
Okay, that generally wraps it up. It is a little after 1, and I would say, we're going to do just a few questions. Who's got a question on the tip of their tongue? Okay, hold on.
I live on in a twin home on a cement slab. So I have service line insurance on my policy. What would happen if something happened to one of the lines that are in the concrete buried?
Unfortunately, that's not insurable. Yes, that part of it is not. And that what happens most of the time in situations like that is it's very similar, like if a sprinkler pipe breaks here, right? And let's say it freezes outside and the sprinkler pipe breaks. Everything that's damaged by the water in here, the tables, the floor, the carpet, the paintings, the overhead projector, stuff like that, all that stuff's going to be covered, right? But you know what's not covered? The part of the pipe that broke. That's not the covered piece. And so it's unfortunate, but that's one thing that the insurance business can't address, is that part under the home. And why? And if logically I'm looking at it, why? Because it's the most expensive part. Because they're going to have to jack out the concrete and they're going to have to excavate and dig and things of that nature. The insurance carriers are trying to do a good thing by doing that, but what they've created is heartburn because of that exact scenario, in my opinion. Yep. Would that eventually be covered? Maybe. But what happens is again, it comes back down to it when there's enough pain or stress in the system, that's when insurance carriers tend to act. And one of the things that used to be not covered that is now in a lot of carriers is something called hydrostatic water pressure. What the heck's that, right? In your basement, if water seeps through your foundation, never used to be covered. Some carriers are starting to cover that now. When that seepage comes through, it ruins your drywall, ruins your carpet, ruins your furniture. That stuff, it was the same scenario where carriers just said, sorry, Charlie, we're not going to help you there. We can't. So they'd point to the policy and say, you should have read it. You didn't read your policy. And they're like, no, nobody reads that dang thing. But I think in the fullness of time, in my opinion, I think that will be one of the items that carriers will be forced to address at some point.
If you have grandchildren, teenage grandchildren driving their car, I mean, they're taking you to the mall or they're.
Joey, will you repeat the question?
She said, should we make adjustments to our insurance if we have teenage grandchildren that periodically drive our car? I'm very conservative about this stuff. Any time that a teenager touches my stuff, I'm buying more umbrella insurance. I just am. Because I told God, we had this conversation over pizza over at the tavern. I believe it was that day. We were like, he's like, hey, how old are your kids? And we were having that conversation about that. He's like, what are you going to do? I was like, it's inevitable. The accident's going to happen. It's just a matter of when. And I shouldn't have said anything because it was like I threw it up to the universe and then it ended up happening. 2 weeks after my daughter had her first car, she got into a fender bender almost immediately, hurt the other person and that car. So it was one of those situations where it's going to happen, life happens, and that's where it happens the most.
Okay, but do you need to add them to your policy?
No.
The answer is no.
No.
The
The
answer
insurance
is
is
no.
going to follow the vehicle wherever you go.
Okay, one more question.
Just a quick question. Guy talked about split limits on auto liability and combined single limits, and I'm certainly a big proponent of combined single limits. And some of maybe you have to explain a little bit the difference between an independent agent company versus direct writers.
Mhm.
But a lot of direct writers are still, is that correct? They're still more or less almost exclusively wanting to do split limits.
Mhm.
And they may not be as willing to write some higher umbrella limits as what I've seen in the past.
Yeah, at times I think every carrier has a different appetite for risk, right? And so the biggest difference between like a State Farm, Shelter, Farm Bureau, they work for that company and then they only sell that company's stuff. Where an independent agent represents you, the buyer, and then has the opportunity to hit the entire marketplace to shop on your behalf and to place the best deal for you. In my opinion, I mean, I'm biased, but that's in my opinion, where you're going to get the best value is when you have that advocate out there doing that every day for you. And then, because then you can have that conversation. What's most important to you? Like it could have really hit home on the uninsured, underinsured motorist coverage for you. But for you, it may be, no, I really need that sewer water backup. Everybody's a little bit different because your home situation is different. You're going to have a different risk when you have a slab on grade like bi-attached townhome than you would with a walkout ranch that has a fully finished basement, right? Everybody's a little bit different subtly on how they live.
Joey, thank you
Yep.
for today.
Thank you. You bet, guys.
All right, I want to thank everybody here so much and that has joined us online. Thank you for being clients of Compass. Thank you for coming today and learning about it. This is how we grow. We grow because our clients care enough about their loved ones to send them to us, and we get to know them and care for them too. So thank you for your business and appreciate you coming today. Have a good one.